Hello and welcome to my morning note. It's what has to be called a very ugly day so far today. We've seen the yields on German bunds rise very sharply after the warning from rating agencies last night that even the core nations of the Eurozone might see their credits be downgraded. Meanwhile, what's happening in the Spanish bond market begins to look ever more like panic selling. You've seen the yields on the 2-year Spanish bond rise to fresh records for the Eurozone era. Plainly, people are very alarmed about the situation there, and it raises the issue of whether we need to worry about another black swan event, an event with a very low probability but with a very extreme consequence, something that we all learned a lot about after the Lehman bankruptcy 4 years ago. Now, with me to discuss this today, with plenty of insights from managing extremely large institutional asset flows from around the world, is the Chief Macro Strategist at State Street Global Markets, Michael Metcalfe. Michael, thank you very much for being here today. Let's start by taking a look at that critical spreads between Spanish and German bonds. What does this tell you? How much of the real contagion effect are we seeing from the obvious fears that are out there in the Eurozone bond markets?
Well, the first point, as you say, is that the Spanish bond market very much looks like it's under extreme stress. And we can see that the spread is at a sort of euro area high, and 2-year yields above 6% are clearly unsustainable. But I question whether actually it's going to be a black swan, because I think for it to be a black swan event, it has to be unexpected. The European crisis has been ongoing for quite some time now. Investors have had some time to prepare. And the interesting thing right now is that although the spreads are out of their wides, actually volatility hasn't accelerated. Okay, so the last couple of days has been reasonably volatile. Yes. But even then, so if you look at the VDAX measure of implied volatility in European equities, or even the VIX in the US, yes, they've gone up, but they're not at levels that we would consider extreme, which suggests that investors aren't rushing to buy protection.
It's more of a calm sell-off or a calm reallocation.
A quiet
of
disaster, yes.
Okay, now let's take a look at, State Street has various proprietary indicators on this. This compares your investor confidence index with what the purchasing manager surveys are telling us around the world. Just take us through how you define or derive that confidence index.
Well, see, what we're trying to do here is sort of fill a gap in the market's information. And so, we survey consumers, we survey business managers, as we have with the Purchasing Managers Index. What we actually do is we look at whether large institutional managers are buying or selling risky assets, and then we turn that into a confidence index.
So at the moment, we're almost as lacking in confidence as we were in the very worst months after Lehman, judging by this.
That's correct. Right. And the one thing, so it's been gloomy for quite some time. Investors have had quite some time to get ready for what's currently going on in Spain. The one thing I would sort of point to, as you say, it's been a very black day, very black couple of days. In terms of potential hope, is the fact, look what happened at the first round of quantitative easing. Right. Look how fast investors responded. And so, we're conditioned to think that policy impacts the real economy with a lag, but policymakers can impact sentiment almost immediately. It's interesting to us, actually, that confidence didn't get worse.
Right. Okay. It could have been even worse.
Yes.
Now, that I suspect could be because there are hopes that the Fed will intervene. And we've got another very interesting chart that plays into this. This is a rather intriguing proprietary measure of inflation in the States. What is this red line?
So we have a company called Price Stats that scrape prices off the internet. We scrape more than 5 million prices a day. And then from that, we aggregate it up into daily measures of inflation across a range of countries. The one that's probably most interesting right now is the US, simply because right now the annual inflation rate of online prices in the United States is 1.1%. Now, why does that matter for the Fed? Well, of course, the Fed now has an inflation target. Yeah. If inflation gets down towards 1% in the United States, then it becomes a reason to ease.
Okay, thank you very much indeed. As ever, there's always a sense that you're clutching at straws when you're thinking that your main bullish point is that things are so bad that the Fed will have to intervene. But in terms of the effects on markets, these are important. This indeed doesn't look as though it will necessarily be a black swan that we need to brace ourselves for, because investors already are braced for something very bad.